Hello and welcome to Gold and Silver Assets. I'm Diora and it's Sunday the 12th of September 2021. I do find that there are some people out there who have unrealistic expectations of gold. When it comes to gold ownership, I think it's important not to look at it with rose-coloured spectacles. We have to remember that physical gold is a very political and strategic asset. And that can make its owners vulnerable to getting shafted in a variety of ways. Now, last week's show was actually generally well received, better than I thought it would be, although there were a couple of people who reacted like this. Oh dear. Yeah, anyway, I was chastised for being too end of the world in my discussion. Well, look, for those of you who didn't like last week's show, you're going to hate this one. So one of the things I find is the doom and gloom response is what you get from people who are inflexible in their thinking. They're very rigid and one-sided in their views. And another common response that you get when putting forward potential scenarios is, that's not going to happen. And they say it with such certainty, but in reality, life is full of uncertainty. And certainly in the last 18 months, we've seen things happen that certainly I thought were close to impossible. Of course, my personal favourite is, that's just a conspiracy theory. That response, I reckon, is the last refuge of the intellectually destitute. Those of you who've been listening to this channel for a while now will know that I try and give a balanced view of the various topics that we've discussed, and I do try and consider all the possibilities and probabilities in making my assessments. And that does mean looking at both sides, both positive and negative. In doing so, that enables us to hope for the best, but also be prepared for the worst. So let's talk about the best and worst outcomes for gold owners. The fairy tale ending that gold owners might have is that gold goes to $10,000. Now, doesn't that sound amazing and wonderful? Those with a decent sized holding would be rich. Of course, that would mean fun, freedom and independence. How lovely. Look, if things turn out that way, then I'm going to be the first person to be jumping up and down and cheering. But look, we mustn't be blinkered about some of the possible negative outcomes. And so there are a few. One common misunderstanding is in treating gold as if it were a stock. Now, in most cases, if you got an individual stock, such as Tesla, that did a 10x, nothing much would have changed in the world. You can take that profit and enjoy spending it. When gold does a 10x, well, that signals significant changes in the world. It's not benign. High gold prices signal problems with the fiat currency, for instance, and that means significant inflation. But that does seem like a bit of a vague concept to really grasp, as most of us haven't actually experienced true inflation. So to give us an idea here, I've got a chart here of the oil to gold ratio over the past 60 years, and I've drawn that blue line there, which gives us an average, and so that average is 0.08. So I think that's a fair assumption, is just to pick the 60-year average there. Now, at this average ratio, a world of $10,000 gold would also be a world of $800 oil. Now think about that. That has all kinds of implications for the economy, the price of goods and services, and your life. A world of $10,000 gold may also be one that's afflicted by financial, social, and political turmoil. That, in association with inflation, is also likely to mean shortages. So owning gold won't guarantee that you'll be able to get hold of whatever you want to purchase. Having said that, in a world of $10,000 gold, owning the physical metal would be crucial, as it basically gives you greater purchasing power, certainly more than you would have today. And it would at least give you some hope of maintaining a comfortable standard of living. So physical gold is therefore an insurance policy, and it's one that you really don't want to have to need. Now, believe it or not, this is the best case scenario. There are actually a number of ways that gold owners could get shafted along the way. So I've been watching a series on Netflix called How to Be a Tyrant. It's quite interesting. I would recommend watching it. Anyway, that show outlines the tactics that tyrants use to achieve their goals. So here I've put together a list of tactics that have or will possibly be used to minimise gold ownership by the general population. Tactic 1. Make it painful to own gold. One method of doing that is through manipulation. So suppressing the price over long periods of time discourages ownership by both retail and actually institutional investors. And that was certainly effective over the 80s and 90s, but obviously something happened from the year 2000 there. Watching your investments stagnate in fiat terms while stocks skyrocket is unbearable for most. Manipulation also occurs in psychological form through the mainstream media. So such media outlets often fail to mention that in the last 20 years, gold has returned double the amount that the S&P 500 has. Another way of inflicting pain on gold owners is through taxation. If gold prices rose substantially, then governments could get their pound of flesh by increasing the capital gains tax specifically for gold. I mean, who's to say a 70% tax is out of the question? Alternatively, there could be a gold ownership tax where you pay, say, a 10% fee for the privilege of holding gold. In this way, the benefits of a $10,000 gold price can be diminished for the retail investor. Tactic 2. Make it hard to buy or sell gold. The classic weapon of choice is, of course, onerous bureaucracy. Create a variety of ridiculously long and tedious forms that are mandatory to complete. Have registration requirements and regulations to wear down honest dealers. Another method is to directly control or even ban transactions involving physical gold. And this is something that might be achieved through the introduction of central bank digital currencies. Such a system means that all transactions are trackable by the government centrally, and this gives them access to huge volumes of data. It also enables individual transactions to be blocked or controlled. This means that people could have restrictions in terms of how much or whether they can even buy or sell physical gold. Maybe they ration the number of ounces that people are allowed to buy. Central bank digital currencies will make it easier for the government to enforce taxation. Heck, they could just take it straight out of your account. When physical cash no longer exists, that could also put the legal tender status of gold coins in jeopardy. And also it could bring all sorts of problems when it comes to selling offshore gold. Tactic 3, make it illegal to even own gold. If the government makes it illegal to own gold, then they will expect you to sell them your gold, and non-compliance would be met with punishment. Now, this is a topic that's often brought up in the gold community. How likely is this to happen? Well, one of our viewers mentioned something that got me thinking, and actually I think it's going to depend on where you are located. The first factor to consider is ownership rates in your country. By that I mean, let's say you're going to go to your local supermarket and you ask 10 random people if they owned any gold bullion. And look, let's assume that they answer truthfully. Now, over here, I reckon you'll be lucky if you've even found one person who answered yes. If you went to India or China, it'll be more like 9 people, I reckon. I wonder whether in countries with low ownership rates, confiscation is less likely to result in a public backlash, and so it would be perceived that only the rich own gold and that they must be punished. So maybe confiscation could be introduced in countries with low ownership rates. I'm not sure. I also think that it ties in with cultural attitudes to gold. So in countries where people have a culture of preserving their wealth in gold, I reckon they're unlikely to put up with confiscation without a fight. Speaking of culture and finance, I actually came across an interesting anecdote the other day. So apparently the US military were trying to go around visiting tribes in Afghanistan to try and teach them about taxes. And when it was explained to them, their response was, "But no, that's stealing." The type of government in power will also determine the likelihood of confiscation. So yeah, it depends what their leanings are. And of course, the laws of the land also matter. So a common defence I hear in Western countries is, oh, we have the rule of law here. But did you know that in Australia, there's actually a law in place as part of the Currency Act that states that the government can not only confiscate the gold of its citizens, but they can also determine how much they pay for it. Basically, all it takes is the stroke of a pen. In conclusion, owning physical gold is not the same as owning other investments such as stocks. A high gold price sounds the alarm that there's something wrong in the world. So personally, I'm not rooting for $10,000 gold. Having said that, owning precious metals, particularly physical gold, provides a form of insurance. So what you're trying to avoid is getting left high and dry if things go belly up. But don't look at it with rose-coloured spectacles. It's not necessarily going to be your complete saviour here. There are multiple ways gold owners could get shafted, and knowing this allows you to allocate appropriately and also have contingency plans in place. Next up, the market update. Let's start with the US dollar index, and this time we've zoomed in on the hourly scale. And the reason I'm looking at this is because I think at the moment it just seems very, very pertinent to what the precious metals are likely to do. Here's that confluence of resistance where I thought price would get rejected, and it did. It came pretty close to that anyway. And we saw the dollar index drop down to around 92 level, and we've seen a bounce up from there. Now, is this bounce over? I don't think so. I still think it's got a little bit more upside to come, maybe around this 93 level, because we've got all this kind of price action all over here. But potentially, I mean, it could still go up towards this this line here, which is part of that channel, if you look at my previous videos there. So that's the kind of range we're looking at, 93 to around 93.3. But yeah, I think the most likely turnaround kind of area is going to be somewhere around here. After that, I think that this is going to dump quite significantly. Certainly, if we get below that 92, it could be a pretty steep, sharp decline. Okay, so if we are going to get a little bit more of a rise in the dollar index, that gives us some ideas of what could happen in terms of the precious metals. So let's go and have a look at that. So this is gold price in US dollars on the daily scale. And last week I was hopeful that we'd get up to this line, but we didn't. We rolled over here. Now, where do we go from here? I actually think there's still some more downside to come based on what we saw on that US dollar index as well. So the next question is, how far down are we going to go? So one way of looking at this is to draw this Fibonacci extension here and retracement, whatever you call it. Anyway, we haven't even reached the 38.2 yet. So that's one of the reasons why I think there's more downside as well. So that adds support to that idea. One possibility is that we bounce off that, but I think more likely, I think we're going to go a bit deeper just based on the magnitude of the move that we could see in the dollar. And so I would favour more towards the 1760 or the 1740. I think if we get below, 1740 here, you can see we've got support because of this price action here. So I think that's going to be somewhere around here is going to be the most likely point where we could potentially turn around. In our parabolic move model that we've been looking at in previous weeks, then next week we don't want price to go below 1720 ideally. And I think that kind of fits. I mean, if we break this kind of support here, I think that it's not going to be looking too good for precious metals. I'll talk about that in the next slide for those of you who are bearish. But look, I'm still thinking what we're probably going to do is somewhere either at 1760 or 1740 or somewhere in between there. I think we might get a turnaround at that point. And I'm actually wondering if we actually, there's two scenarios here. One is that we break through here and then come back down, and then, you know, the usual zigzagging that goes on. I mean, the other possibility is this thing gets dragged out, and so we can go up to here, then come back down, which would mean the rest of the year would be very, very boring. More sideways actions. And look, we can't rule that out as a possibility as well. So this line here and what happens here is going to be absolutely crucial. Okay, so as I said, what's the worst case kind of scenario in terms of the bearish side of things? You know, what could go wrong here? So as I said, I think if we go below 1720, then I think we're going to actually break those recent lows here. So we've got three hits of this line. So 3 is usually about as much as these lines can take, and I think the fourth one would probably break. So we don't want that to break. If it were to break, how low could it go? So there are a number of ways of looking at this. One would be, again, use the Fibonacci ratios here. So at the 0.5, that would bring us to around 1620. And I guess, I mean, there's a little bit of support there over here. And then even worse, I mean, would be if this dragged on throughout the rest of the year, would be kind of looking here about 1510. So, you know, you can't be blinkered. You've got to think of both sides, and that is a possibility as well. But I think the US dollar will be what kind of guides me anyway for this, and that's why I think we're in for upside and we'll stay within this. But hey, look, I've been wrong multiple times before. Okay, and then we'll look at the silver in US dollars, and this time again on the daily scale. Silver is really, really difficult one to suss out. We've had a couple of false breakouts to the upside. If you remember, we had a trend line here and we got this false wick going up here. So then I redrew it, and again we got some false wicks up here as well, and prices rolled over again. In terms of this one, I wouldn't want it to go significantly below 23. So that's actually not too far of a drop. If it goes below that, I mean, yeah, 20 even. It could go 22, and 20 is even not out of the question there. But yeah, when you're looking at sideways markets that aren't trending, it's very, very difficult. It's grinding and it's boring. So usually it's best to acknowledge that as well. Okay, and then we've got the gold miners. This is the GDX on the daily scale, and I've drawn this channel by joining these two lows, and this is actually a really important area here. And that's because it has been long-term support, and we don't really want to go through that. If we do, I think there is potential for substantial downside there. Now, remember we talked about this gap here, which did bother me at the time, and what we've done is we've rolled over again, and I think we are going to close that gap. So, you know, I think we're going to go to at least 31. Whether we go below that, well, let's see. I mean, it depends on, first of all, how much gold drops, but also, you know, there are times when the gold miners don't drop as much as gold. And so if we see that, where gold miners perform better than the physical metal, then that would be a potentially good sign. So look out for that. And next we have the silver junior miners on the daily scale. And again, sideways, grinding and boring. We've got this gap here, and I think it's going to want to fill it. I mean, we've got a lot of red candles here. There's no sign of that momentum slowing down really. And remember below, we've been looking at this distance from the 200-day moving average. So what I've done here is move it as far back in terms of the height here and join that up. So we're kind of going up and down within this channel, and there's no sign that it's breaking out of that channel. And here we still have room for a bit more downside as well in terms of that. So, you know, until we start moving out of this and this moves above its 200-day moving average, just got to be very wary here. Okay, and now some of you might have remembered from last week that I was talking about how over a week ago there was a cyber attack in New Zealand where there was an outage of the internet for about 15% of people. This week we've had another one, and this time it affected two major banks as well as the New Zealand Postal Service and also the Tax Revenue Service as well as the Meteorological Service. So all of their websites were basically affected by a DDoS attack. That's a distributed denial of service attack. So it basically meant that people couldn't access their websites, or if in the case of a bank, they couldn't access their bank accounts. And I know that for one of the banks, it lasted for 3 days. So that's something worth thinking about. You know, a lot of people say, you know, whenever I talk about risks, and particularly for digital holdings, people kind of brush it off and say, oh, that's not going to happen, or that's a low risk, or oh, it won't affect me. But this can happen anywhere. And so it's always worth thinking, look, if you can't have access to your investments for a certain amount of time, it could be a few days, it could be a week, it could be a month, how will that affect your life? And do you have a contingency plan so that you can still keep going? I think it's something really important to think about there. We've had quite a few of these kinds of attacks, really, over the past couple of years. Last year, the New Zealand Stock Exchange also had DDoS attacks. And so I think there was something like 4 days where trading just was halted, basically. Also, a few months ago this year, there was one of the health regions in the country, they had their servers hacked, and basically all the data was taken hostage. So every computer and printer in the hospital had to be just shut down. And I don't know how they've resolved it or whether they've resolved it, but that's crippling to that whole health sector, basically. Lots of things had to be cancelled, accessing things like blood results, radiology results, nightmare. And anyway, on a brighter note, I just wanted to let you know that it's actually been 2 years of doing these videos now. It's quite interesting. It's quite embarrassing, actually, when I look back to that first video I did. You've got to bear in mind that I've never published a YouTube video in my life until that point. I learned everything from scratch. And I think I'm really proud of the way that I've grown over these 2 years. I've learned a huge amount and I've really enjoyed it. And I particularly enjoyed interacting with like-minded people. So I want to say thanks to all of you who have contributed in some way. Thanks to those of you who have quietly just watched the videos. A big thank you to those who have pressed the like button. And of course, all of those who have contributed intellectually through your comments. That's been very, very helpful. And of course, those of you who have subscribed. And I'm actually curious to know, who is the earliest subscriber to the channel that is still listening today? If you think it might be you, then pop the date that you first listened, if you can remember it, or first subscribed anyway, in the comments section. I'm very interested to know who is our longest running subscriber that's still listening. Anyway, I think I'll celebrate today for that. Cheer myself up. That's it from me for this week. All the best and see you next week. Bye.